Hey traders, Raghee here. Welcome to Charts and Coffee. Happy Tuesday, everybody. Turnaround Tuesday. Yep, let's not get ahead of ourselves. We are in a downtrend. This is not a news flash. I do want to take a moment just to walk through some market structure, because I think that when you look at market structure first, not the headlines, not the current volatility, you take a look at the bigger picture, and that is what structure is. I don't mean bigger picture as in a weekly time frame. I don't find that to be what you need to focus on. Bigger picture is sometimes a great way to sometimes justify hanging on to a losing trade longer than you should. I think weekly charts have been oftentimes the demise of many a trader looking at a few day to a few week setup, but somehow justifying hanging on with a weekly. What I mean by bigger picture is just where have the trends organized? We have been in a downtrend in the NASDAQ since January 26th, right? We have been in a downtrend in the S&P. We're not yet, right? So you might say, wait a minute, Rog, we're not in a downtrend on the S&P? No, we really actually, based on the way we look at structure, we're not. Now we can look at overbought and oversold. Doesn't mean that you can't short, doesn't mean that we can't buy, but it's not a downtrend. What about the Russell? We have flirted with a downtrend on and off since January 20th in the Russell. So again, think about some of the downtrends that are the best performing right now. They're the ones that have been established far before Ukraine, far before the sort of ratcheting up of the Federal Reserve and the rate hikes, right? They've been preceding a lot of this. What about the Dow? Let's jump into that for a moment. How long has the Dow been in a downtrend? It still isn't, right? So I'm not saying we can't short this. It just means that where should most of our selling interest be? NASDAQ, Russell. What has performed best, and I think most consistently to the downside? NASDAQ, Russell. Now, what's the next line in the sand you can use to make sure you're not picking bottoms? We don't want to do that. That's not even a pleasant mental picture. And that you're not picking tops. Where are we in relation to the 200 simple or exponential? I prefer the exponential. All right, where are we in relation to that? If we are south of the 200, imagine the equator and being above the equator. It's a northern hemisphere and southern hemisphere. Well, we have that in the markets. The 200 is that equator, right? We can be in the bullish hemisphere when we're north of it. We can be in the bearish hemisphere. There is a significant broad-based psychological shift that happens south of the 200. So when you look at the market and you're trying to get an idea of, okay, Rog, this may not be a downtrend, but am I in that bearish, dominant directional bias? Where are you in relation to that? And then if you're using some of the other tools that we made available over at countdowntrader.com, you start looking at the color of the grab candles. When they are dominantly red, that is not an environment necessarily for long-lasting or high probability buys, right? Green is, but not red. So there are ways we can use the market structure, and I'm talking very, very simple ways, and ask ourselves, where is my edge in this market? Is it bearish? Is it bullish? And if I'm not sure, move on to another symbol, right? If there's ever uncertainty about structure, find something else to trade, all right? Now, let me also mention the current geopolitical, the current macroeconomic situations that we're dealing with right now. Do not change your strategy, right? I'm not suddenly trading differently because the Federal Reserve is thinking about hiking rates 3 to 5 to 7 times, whatever it is. We're not changing strategy because of that. No more than Ukraine is changing our strategy for the market behavior now. It's still, is it an uptrend? Is it a downtrend? Is it chop? And depending on which one of those categories the market behavior falls in, am I trend following to the upside? Am I trend following to the downside? Or am I using a tool like a slow stochastic or a ready aim fire to identify overbought and oversold levels, right? So don't succumb to a typical newbie mistake, which is, I've got to trade differently because of Ukraine. The market will behave differently. It's going to be more volatile. I think we can all recognize that pretty easily. But the structure is not different. The way we behave within the trend might be different. The way the chop behaves might be different, but the strategy does not change, right? And this is what timeless means. This is what timeless strategies mean, so that you know when markets sort of normalize again, you're not changing anything. You're not changing indicators. You're not changing settings. You're not changing anything. You're just adapting with the same tools to market behavior. Because remember, most of our indicators are using price and volume to understand, mostly price, to understand what's happening. And as those contract and expand, your indicators are adapting, right? That's what a good indicator does. So you want to think about timeless. You want to think about consistency. The way that we have been trading since January is no different than what we're doing here in March, right? And that's what, by the way, I say timeless because, well, timeless consistency for 30 years, that's the focus, right? Not a new secret squiggle, not some new super special secret strategy. Can I do the same thing and know that I'm working a high probability setup? I say that because I see a lot of frustration still out there, and this does address it, using things that are timeless. All right, so let's jump in. As always, let's jump into your questions. That is what this show is all about. So as we go through the symbols together, remember, I'm going to come back to the same indicators you've seen me use. Many of you for, I was one of our members in my mastery, Debbie. Hey, Debbie. Debbie's been with me since, Debbie, what, 2013, right? Back when we had simpler Forex, right? Way back when. And Debbie remembers grab candles, wave, looking at propulsion dots, Darvis, right? All the things that we were doing back then, we're still doing now. Why? Because it's the consistency in the tools that creates the confidence. Right now, a lot of you, and I know I have those moments too, we're not feeling confident about what we're seeing. Well, be fair to yourself and ask yourself, how long have I been using this tool? Have I really used it in all sorts of market environments where me and this tool have really developed a bond, a trust? I can visually say, all right, that's what that means. I got it. Yeah. So, if you've been with me and been watching any of the content that we've been producing, we produce a lot, right? We really want to help you all navigate these markets. You'll see the consistency in the tools, that timelessness is so important. So RTX, we're going to run the market right through the same process, right? So what are my thoughts on RTX? So Raytheon is now look, here's something we want to step back and ask. How long has Raytheon been in an uptrend? Easily since the 4th day of February. So this is a month-long uptrend. Dips have been bought, but they're a little volatile. Raytheon has changed its personality a little bit, right? Look at the size of the candles. You don't need to be a high-level technician to say, whoa, these candles are bigger. There's more volatility now. That is true. So we adapt how? We're going to buckle our seatbelts when we buy a dip in Raytheon. We're going to adjust our expectations for volatility, even though we know the path of least resistance is probably higher. The way in which it moves is going to be different than it was, say, end of January, beginning of February, as opposed to now, end of February, beginning of March. So I like the dip, right? My thoughts on Raytheon are 13 and 21. My preference is for the 21, but I want to show you here something. Right here, that is a volume ledge. So I've got volume corresponding pretty tightly, not perfectly, but pretty tightly with those two levels. So I'd like to see the market come down to the 13 or in that 21 area, and then look for an opportunity to get long. So we want to scale into something like this. Tom, We talk about scalability instead of large account, medium account, small account. But the truth of the matter is, it doesn't matter the size of your account. Trading, risk management, position sizing is not like a ball cap. It's not one size fits all. It is what's in my account, what can I afford to risk, and how do I scale into a trade? So the scalability here is, can I afford to take heat from, say, the 13 EMA to the 21 EMA? If the answer is yes, it's a scalable level. If the answer is no, then you've got to wait for that lower level. So that's part of the process. And if there is a holy grail to trading, it's not a secret squiggle, gang. I think you all know that. It is that risk management, which is part and parcel with position sizing, right? Talk about timeless. All right, Mike, good morning. If VVLF, okay. I don't know what that is. VVLF, unless that's I don't know what that means. It's a typo. Okay. If price, sorry. I'm assuming that's if price stays, here, let me go back to RTX. If price stays between an entry and a target, when price doesn't move to the target or stop, does time become, okay. So what if we have an entry? I'm trying to think of one that we have right now. I'm trying to think of an open trade in our mastery that's in no man's land. That's what I call no man's land. It hasn't stopped us out yet, but it hasn't hit the first target. So we haven't hit our risk threshold, which, by the way, is never, never, never CVS. I was just thinking CVS. All right, the bot to the rescue. CVS is a good example. Okay, so CVS, we took a little heat. It's back in play, but it hasn't hit a target. When does time? So time, or theta decay, when does that become an issue? It becomes an issue typically within 21 days. But I don't start counting days in the calendar. So, Mike, what we're always doing is asking ourselves, what have we paid for the option? And what percentage of premium value have we lost? So I'll go back to something I say a lot. There is never, if you're playing a directional debit, what do I mean by that? Long call, long put. There is never a reason, and I don't say never very often, gets me into trouble. There is never a reason to risk max debit. There is a point in the life cycle of that trade losing value, your premium, that the trade is no longer valid. That's no longer a valid entry to be in anymore. So we have a particular threshold. That's what we do, where we say, okay, when we lost X percent, or we're risking more than X percent of our account, there's two levels. At that point, we get out. So oftentimes before theta decay becomes an issue, oftentimes before the price movement against our trade becomes an issue, we're going to have said, look, this trade isn't working for us. We're going to get out. We're going to take the paper cut. We're going to take a small loss. We're going to get out while we can, not when we have to, free up that capital, both mental and quite literal in our account, and move on to another trade. So point of validity sometimes can be time, but oftentimes it's really not. It's going to be a percentage of risk, and that threshold is met. So yeah, with CVS would be a great example of sort of taking some heat. It's come back, just sort of floating around, not doing anything. It's not hurting us, but it's not helping us yet either. Where would we cut the trade? It's still going to be a percentage of premium paid. So I hope that makes sense. All right, and I do use a fixed bet type risk, because the fixed bet, that's what I teach, it presumes the only truth in the market that exists. We don't know what's going to happen. I can't look. Right now, we have, I think right now, and I'm thinking in the mastery and in my own personal book, I probably have a mixture of longs and shorts, 14, 16 positions open right now. So we have a very full book. And so when I look at that book of trades, Mike, I think about which ones are at break even. I think about which ones are in that no man's land, like we talked about, and every single one of them, I'm going to presume, and they are fixed position sizes. Not one is not larger than another, because of those, I'm not going to say, well, this one's going to win and this one's not, right? So we also think about the fact that our position sizing should be relatively equal. because we don't know what the winners are and we don't know what the losers are going to be. And a lot of times traders position size thinking, oh, well, this is going to be a winner, right? That again is going into fortune telling and not actually trading. So thank you for the question. Really good one. Mark, the Christmas tree is lighting up looking at Euro versus US. Yeah, we've been short 6E since 115. So the Christmas tree is lighting up. I know I know the register has been ringing, that's for sure. So this is still a very nice downtrend, and we're going to continue to just take advantage of now rather than fading 115. Now, my futures traders out there, we've been talking about 115 since what? Since the beginning of February. We had 2 shots at that level. That's how kind the Euro versus US was to us. This is what? This is a proxy for dollar long. Euro short is really the most direct path into dollar long. And some of you might say, well, Rob, wouldn't that be the dollar index? It's not. The dollar index is a basket. The dollar index is a basket of 58% euro and then some fairy dusting of some other currencies. The most direct route, most direct inverse correlation, negative correlation to the dollar is the euro, which has just gone into a downtrend now as of yesterday. So now we're going to short the rip. So we had an overbought fade off the ceiling at 115, and now we're going to look to short the rip. So love that setup. We're going to continue to take advantage now of bounces and short them, right? Almost on what, 400 ticks into this trade. This is why we want to have different strategies appropriate to the structure. See, it wasn't appropriate to buy here, but it wasn't appropriate to call it a trend. So that's where we look at a choppy market opportunity. We get a pop in this chop. It moves up to the resistance level. We short it because the trend that preceded that was down, right? If this type of structure recognition and adaptation, if what I'm saying kind of sounds like Swahili, but clearly we're slaying the market right now in an environment where, it's very difficult. Markets that are moving, even if they're volatile, are where traders do best. Not markets that are moving straight up, not markets that are moving straight down, markets that are moving. So if you're having a hard time sort of finding your sea legs in this market, we're going to be talking about all this tomorrow. I'm going to be walking you through winners and losers for the past couple of months tomorrow. So if you haven't registered yet, check out simplertrading.com/timeless and all the stuff that we've been talking about in Charts and Coffee. I'm definitely going to be walking through that because it's probably more important than ever to really dive into a lot of this and make sure that if we're going to be dealing with this for a little while longer, and I'm not going to say unfortunately we are, I'm going to say fortunately these markets are moving and giving us opportunity. But if you're not able to find where the trends are and where the chop is, I have to imagine it's been terribly frustrating, but it doesn't have to be, right? It doesn't have to be. All right, so what are my thoughts on buying ES spreads, buying MES calls and puts for a small, medium account? Jamie, I appreciate the question. I am directional. I'm not playing ES right now, but I think we will be adding that to the approach. We've continued to focus on the NQ. I'm not a big fan of spreads. Not that there's anything wrong with them. Okay, please hear me out. Oh my gosh, Raghee doesn't like spreads. No, I like traders prioritizing direction. And if the spread is built on the clarity that I think the markets are going to continue to move lower. Look, right here and right here, these are the past 2 shorts in the NASDAQ. And let me give you the specific dates. February 9 and 10, February 1, and February 3. Those particular dates were great for anybody looking at directional debits. For us, it was long puts. What do I mean by directional debits? I know the direction and I'm buying a put. What if you wanted to sell call options? Traders who are scrambling into the market, overpaying for calls, and the markets are in an overall downtrend. You want to collect premium. Same timing, my friends. You might say, okay, how can I sell calls in an overall down market when I know I have an advantage to collect some premium here? Same timing. What if you wanted to do something where you wanted to put on a spread? That's fine too. The timing is the same. But my theory is this: if direction is not clear, structure dictates strategy, then it doesn't matter what type of strategy we use, what type of multi-leg strategy we use. It's not going to be as effective as a strategy that recognizes direction and then uses timing. Timing and direction are something that everybody, as a trader, whether they're playing debits or playing credits or spreads, whatever it is, right? As options traders, direction and timing are inevitably going to be where either an account growth is found or an account starts to shrink, right? That's the bottom line. So I don't, for medium to small accounts, you know what we do, Jamie? In my mastery, cash account, long calls, long puts. That's it. We focus on options that are typically under $500 to $600. Still have a great trade at night. A lot of folks said, "Well, Rog, how much does a trade like this cost?" Gang, it was under $600 per option. I think it was $575. Right now, I think we're 3 or 4x. Now, this is a dramatic move, so I'm not always looking for 3 or 4x trades. I'm looking for about a 50% return, right? I wasn't expecting that much. This is just a trend that's kept going. But if we're focusing on very expensive options, I'm not trading Google. I did talk about some shorts in Tesla and things like that, but I really want the setups to be affordable at the onset so that if you want to trade a spread, cool, you can, but you don't have to. Think about why most traders trade spreads. The underlying option's too darn expensive. But what if you could find those gems out there that are under $600, $700, oftentimes $300, $400, $500? And now you say to yourself, oh, I see how you can scale in now, Rog. I see how we don't have to build a spread unless we want to. That's why I love cash accounts, because they make us focus on the direction and the timing. And then once you get good at that, my gosh, you are going to slay it with spreads because you've got a direction and timing prowess that most spreads traders just never had to develop because they figured the spread was going to be that margin of error for them. So imagine not needing that. And then you've got that sniper-like accuracy, you got that pinpoint bullseye accuracy. That's the way I look at it. All right. So thank you for that question, Jamie. That's really, really a great, great question. My gosh, how did 20 minutes roll by that quick? I will see you all tomorrow, same time, same station, 9 a.m. And then remember, 8 p.m. tomorrow. If you can join live, cool. If you can't, register. We'll send the recording out to you all. Make sure you download the free indicators, gang. This is not a promotion for a new secret squiggle. I don't have a class coming up. This is not a promotion for either one of those. We're going to talk about what we've been doing in my mastery. We're going to talk about actual trades that members have been taking, and I'm going to just break them down so you can see what we've been doing. All right. I'll see you tomorrow. Be good to each other. I'll talk with you soon.